Hi, I'm Tobias Carlisle. This is the Acquirers podcast. My special guest today is Chris Buckey from Lasky. He's a multiple startup founder. He's very familiar with the ins and outs of Silicon Valley, raising capital, starting businesses, running businesses, selling businesses, identifying what works and what doesn't work. We're going to talk to him right after this.
Tobias Carlisle is the founder and principal of Acquirers Funds. For regulatory reasons, he will not discuss any of the Acquirers funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquirers Funds or affiliates. For more information, visit acquirersfunds.com.
What's your background?
Yeah, so I'm a founder and a operator occasionally. I kind of differentiate those two a little bit, but I definitely do a lot of investing and stuff like that. But I think primarily, like day to day, the vast majority of my time over the last 10 years has been spent either starting companies, running my own companies, or running other people's companies as an early employee. And so really got started like 10 years ago. And so out of college and joined as an early employee at a real estate startup here in San Francisco. And that's just kind of like created this whole crazy whirlwind of three different startups, now on my fourth over the last 10 or 11 years. And so really spent like probably the first 5 years in real estate tech, and then the last 6 years in HR tech and recruiting tech, with a whole lot of like small company selling to big company, working at big company, going back, starting or joining something else that's small, and just kind of like repeating that process quite a bit over the last 11 years.
So real estate is the uniting factor?
Yeah, I mean, I love real estate. I spent, like I said, like 5 years in real estate, and then when I was in real estate tech, started buying a lot of my own properties in like 2012. And so have always been an investor in real estate. From a founder perspective, haven't worked at or been running a real estate tech company since 2015. So the last 5.5 or 6 years has been super focused in recruiting tech. And then, now with my current company that started about a month ago, doing something totally different again. So it's like, I think I just get really bored after 5 or 6 years in an industry. I find that once you're in an industry and you do really well, everybody wants you to help them, invest in them, advise them in that industry. So it's hard to ever get out. So I spent, again, 6 years in recruiting tech, was absolutely exhausted. And now every recruiting tech company wants to work with me and wants to have me as an investor. So it's hard to ever leave, right? Like, I think it's, there are these like patterns of like going deep into an industry for a few years. And again, if things work out well and you meet lots of people, I want to support those people as a, angel investor or LP or whatever. So yeah, I mean, but certainly real estate is definitely a passion of mine, but don't consider myself kind of you're not
a real estate guy.
Not like a sponsor. Yeah. Not like through and through a real estate guy by any means. Yeah.
So what's the current project?
Yeah. So Lasky is the company. It's lasky.co. And I'm teaming back up with my previous co-founder, and some of our early team from my last company Interviewed. So this team has worked together for 7 years now across 3 companies. And we are helping mostly mid-market companies as they go from like usually a few $1 million up to like tens of millions of dollars in revenue. Mid-market SaaS companies for the most part, but also working with a lot of marketplaces, really coming in and helping them from a strategy and sales perspective, grow that revenue and kind of build out the playbook and put the processes in place to make that happen. So, our team's done this at several companies, and now we're kind of creating a model through consulting plus software that we're building in-house to actually help, a bunch of other companies do this.
So when you said earlier that you'd been both a founder and an operator, and sometimes you said that there was a distinction between those two, let's talk a little bit about that. What's the distinction between the two? What sort of skills do you need?
Yeah, I think, founder is... It really is, I think, distinct because the job is doing quite literally everything. Like I've spent hours trying to figure out this like incorporation issue where, one of our founding engineers is in Canada and we're based in the US. And it's like, you're wearing like the part-time accountant and part-time, state registration expert and, part-time lawyer hat. And you're dealing with kind of all these experts. And then you're switching gears and you're writing code or you're like selling the projects. You're pitching clients. And so it is this kind of like, shit show where I think, in my experience, an operator, almost always in my experience, it's this much more streamlined process where you are, as a founder, you're trying to find what works. As an operator, I think you're taking what has been working and, scaling that to the next level or like putting the process in place to do that 100 times over or do it, 10x better. And so I think from my experiences, like, the two companies that I've started, it's just like, the first year, no matter how many times you do it, I have a lot of great mentors and investors and stuff who say the same. And it's just like, it's always chaos. It doesn't matter. There is no playbook. You're entering a different industry. You're hiring, you're trying to figure shit out. It's a mess. As an operator in my last role, I led enterprise product for a division at Indeed, which is, over 10,000 people. Hundreds of people on the enterprise team in engineering roles. And that was not chaos. Like there were billions of dollars in revenue there. And that was a story of like, how do we grow this, already great machine and kind of take that to the next level. So, again, I think as a founder, it's like, how do we consistently from like a revenue perspective, how are we 10xing or 100xing, for the first like, 2 or 3 years? Obviously at a large company as an operator, I've worked at Zillow, right around the time that they went public, and then Indeed. So both, kind of these large, these fairly large publicly traded companies, and it's a totally different beast. So I like doing both. I certainly like starting companies more, but I think the nature of starting a company is that, if things go really well, a lot of the times that ends up in an exit. And you end up working at the acquirer. And so, both of my experiences of working at an acquirer post-acquisition have been great.
How long did you last?
Experiences. A little longer this last time. The company
How long is
great.
that?
The first time was selling a real estate tech company where I was an early employee to Zillow in 2012 and lasted about 1.5 years at Zillow. And it was very fun, but it wasn't. It definitely became monotonous fairly quickly. I think I was like kind of like low middle manager. I was probably like 24 at the time or something like that. And the company was growing really quickly, so it created like a ton of like untapped opportunity for me at a pretty early age, which was awesome. But this last time was 3 years. And when we sold to Indeed, and actually the founding team all left around the same time, about 2 months ago. But we were the first people on our team to go, which I think really speaks volumes to Indeed as a company and as an acquirer, that we were, I think, one of the first companies that they had acquired. And it's like I said, this fairly sizable company of over 10,000 people now, and the fact that all of our team, from product people to engineers to UX to sales, are still there, I think is pretty powerful, almost 3.5 years in now.
You favor the standing desk?
Yeah, I've got both. I switch back and forth. I actually I just got this set up and it works pretty well. I've got the books behind me so that people know that I'm smart.
Nice.
And we've got the plants so people know that I'm cultured with the artwork. And it's important to convey that to clients for sure.
Yeah, I feel the same way. I got the standing desk with the walking treadmill just there because I've got like ADHD or something. I've got to be like doing like 10 different things at once. Where are you based in San Francisco?
I've been in San Francisco for, 11 years. And so my now wife and I, we were dating and living in the city in San Francisco. And we were there for about 8 years, together. And now, for the last, almost 3 years, about 2.5 years, we've been out in Danville, in the East Bay, where, We can like hear cows in our
Oh,
backyard.
nice.
You pass like horses on the way to our house, so it's very different than passing car break-ins and piles of shit on the street. But it's a whole different vibe here. But we're only like 45 minutes to the city.
It's cow shit rather than human shit.
Yeah, exactly. A different kind of shit you're dealing with for sure.
Yeah, I lived in San Fran for a few years with my girlfriend, now my wife, and we had this nice view of the Bay Bridge. We were on Clay and Jones, which is where
Nice.
it's got the famous Bullet bodega there, where they film the scene where the car loses six hubcaps through the course of
Yep.
the car chase, which is hilarious because
Yep.
there's four wheels on the car. It was really beautiful. It had this shot of had this like angle on the Bay Bridge, and because you're rent controlled, you're fine when you're there. But I don't think I could afford it anymore. I think it's gone bananas there, right?
Totally. Yeah. It's out of control. When were you there?
2004, 5, 6.
Okay. Yeah. It's I mean, it's
I was like, there's nothing going on. There's nothing happening here, so
it might
it's
be
all
better
over. I
now.
missed it.
You're right. Yeah. When I first moved to the Bay Area, back to the Bay Area, I was born in San Jose, and then left when I was growing up in Colorado, and then went to college in Los Angeles and came back, and I moved to San Mateo in kind of like Burlingame area in the South Bay, and had like a roommate, and we were in like a we were in a 3-bedroom house that was like 2 bath, but it had like a 1-car garage and a yard and everything. And we were paying, I don't know, like $2,300 a month or something. And like last year, I've tracked that property, and I know that it's at some point, I think like at the peak of the market, that like $2,300 a month place was going for like $6,700 a month, 9.5 years after we left. And I mean, that's in, certainly like non-central business district, 45 minutes south of the financial district in San Francisco. So yeah, it's gotten crazy.
You're at school in LA?
See what happens. Yeah. I went to school at Pepperdine.
Yeah, that's a really nice area right there. So when you're thinking about opportunities that you want to, if you're going to do one of these things, you know how hard it is to get something going, to run it once it's up and going, and then to exit it. So you know that there's this like all-in commitment for some years at least. So how do you think about these opportunities? How do you find something that's kind of big enough and interesting enough that you're not going to get 6 months into it and say, there's something else that's more interesting out there that I should be doing?
Yeah, I think I invest in a lot of companies, and I work with a lot of founders, and I'm personally, because it's my own capital when I'm investing, I'm actually a big fan of these like middle market opportunities. There's the stuff that you like, that you bootstrap, or maybe you work on the side for a few months or a couple of years, and really the goal there in a lot of cases is like, how do I get this thing to $1,000 a month in extra income, or $10,000 a month in extra income, so that I can go work on it full time. And then you have the opposite side, which is VC, which is largely, if you're not talking about like when we sold our last company to all of our early investors, we returned about 15x their money in 2 years. And I think, we had 20 investors, and we probably got like 3 great job emails. Like nobody gives a shit about 10, 15, 20x returns in VC. Most of them great people, and still super friendly with all of them today. But that's the gist of it. It's like, if you're not the kind of true outlier in a portfolio, it's a challenge. And so I think that there's massive opportunity somewhere in the middle there, where it's like, I don't care about making $10,000 a month, and I don't want to just like do this kind of like solo entrepreneur thing. To be honest, I also don't care about building like a 10 or $100 billion company. And so I think that, whether you measure it from a revenue perspective or an exit perspective, both as an angel investor, but also as a founder, it's an amazing deal to raise like $1 million or $2 million from angels who are happy about, getting a 10x return in 2 years, and build that business for a couple of years and sell it for, our first company we sold for 45 million. Our last company we sold for a bit more than that. And so, but both companies had not raised, a ton of money. And so for the founders, and for the early team, these are amazing exits, and investors, they're not getting out of bed and writing blog posts about those types of returns.
That's ideal, right?
They're super happy, right?
It's
and
even
they'll work
better
with you again. Yeah, exactly.
So the idea is you start it up, and then you can sort of fund the initial stage from your own capital, and then you get to some point where you need to sort of scale, and you go to an angel. What sort of terms do angels look for? Because when I've done a little as a lawyer, I did some VC, and that the documents that we used to, and I was always on the side of the VC, not on the side of the entrepreneur. The terms that we would hand across, I'd always be like, this is the only way that someone's going to sign this stuff is if they are so focused on just getting the pat on the back from the VC, like this is the stamp of approval that you've got the money from this guy. Right. But if you look at the terms, it's like you got 25% compound in these prefs for the VC to get paid before you get paid. So if you don't get over that hurdle, there's not going to be much left here for you as a founder. Like you've got to be confident that you're going to smash this out of the park. So what do you get from an angel? What's different?
I think, one way that the industry has really transformed, the first startup that I worked at in 2010, as an early employee, the terms were largely up until, probably like 2012, 2013. I think it was very common that you would have these wildly different terms from different, investors, and you would have, most favored nation. And so you had to be like really careful about, I think sequencing capital in. And even as a small startup, I think, that first startup that I worked at, I think the seed was around like $1 million or $1.5 million. And the company was founded in Boston, I think 2 years before I joined. And it was largely Boston VCs. And I think probably every one of those VCs had their own paperwork. And so, also, as a lawyer, it's like when you're raising $1 million or $1.5 million, and you're dealing with, even just like 4, 6, 8 people on the cap table coming in with wildly different terms. I mean, I think very commonly companies who are raising $1 million were immediately turning around and spending, $50,000 to $75,000 of that
on legal fees.
On lawyers. Right. And so this is the thing where it's like, I think in that 2002 to probably like 2012 range, this is like where, it's a great time to be like a service provider. Like you want to be doing back office services, accounting, law firm for these companies. VCs aren't making a ton of money. Founders may not be making a ton of money, but and then over the last 10 years, it's certainly been landlords. And so, now I think really what's transformed at least the early stage industry, and I think this is fairly specific to the U.S., although I think it's growing pretty rapidly outside of the U.S., is this concept, at least for early stage financing, of a SAFE. Yeah. And so, with SAFE notes, which were standardized by Y Combinator, probably starting eight plus years ago. But really started to become ubiquitous with almost all YC companies, shortly after the fact. But now, I don't even know if YC, it's hard to track the numbers because these are just available on Y Combinator's site. But, there are these like very simple standardized documents. A lot of VCs initially. Do you
want to just explain what a SAFE is?
Yeah. So a SAFE is it's basically it's a form of a convertible note that converts to future equity. So, I think largely the way that these are structured is, trying to do convertible note where you're not actually having to go through the process of, selling equity in a deal, and the deal is a little bit more flexible, but doing so in like a 2 or 3 page document, whatever it is, where, these are, I think, ambitiously founder friendly. So, there's a couple different forms of a note, of the SAFE note. And so you can do things like giving a discount, with that note to early investors. You cannot give a discount. I think that there's one where you can actually, pay interest, on, through a SAFE note. So there's a couple different versions, and occasionally, companies will do side letters. I would never advise that. I think it's super easy to get 20 people on your cap table with, $50,000 or $100,000 checks that all sign the, exact same SAFE note. You pay 0 in lawyer fees. You pay 0 to kind of get that funding. And then when you go convert it, and you're converting into, equity in a Series A or at a later round, these are all kind of commonly recognized by lawyers, and lawyers, I think largely, and accountants largely have a pretty streamlined process. Like they've dealt now with companies that use this form of a convertible note to convert that into future equity. And so I think it's a great tool for founders, but it also works super well for VCs, because I think, look, like, I don't think that VCs 10 or 15 years ago enjoyed the process of like having to explain to founders why the founders needed to pay $50,000 out of pocket immediately, and now that $50,000 can go to an early sales hire or half of an engineer or something. So it's a much more capital efficient way to kind of get the first, usually like million or $2 or $3 million into the company.
Do VCs use safes or angels?
Yeah, I think or angels use safes. Definitely early stage VCs will sign safes. I don't know if it's their preference, but I think what we've seen is like from VCs, there has been this rush to go down market. And so by that, I mean, it's like, a lot of these companies or a lot of these VC firms who were focused on like middle or late stage venture capital, they were doing like Series B, Series C. Generally, we're talking like $10 million plus in terms of check size. Certainly a trend in the last, I would say, 5 to 7 years, where a lot of these firms have come down and started writing at first like $1 million checks to lead a seed round or to co-lead a Series A. And now, I mean, you see through different scout programs and, different ways of like introducing very small checks. I think VCs realized it's highly advantageous to A, build that relationship on day one, and B, just as importantly, like you're getting data points, you're getting the investor update, whether you have a $10,000 check or a $10 million check, you get access to the founder. We had people, I think our minimum check size in our last round at my company was, probably $20,000, but whether you were putting in $20,000 as a VC, a seed stage VC, or as an angel, we were sending you the same update. We were meeting with you, taking your calls. And so it's such a great way, even for these, 300 million, 600 million, like multi-billion dollar funds to get access and buy them access for $25,000, $50,000 pop. You've seen this kind of like, in some cases it's super focused. In some cases it's much more of a spray and pray approach, just like invest in every early stage company that we can, and we'll just like see, and $25,000 isn't the end of the world one way or another, but it gives us like the leverage and the FaceTime with the founder to put in a much larger check down the road.
That's interesting. So they're using it like an information gathering exercise, like a min raise in poker or something like that, just to see who else wants to stay in the pot.
Yeah.
So
exactly.
Safes I'm familiar with the safes because I've just read them. I've never negotiated one, but I'm a little bit pre-safe. But the reason that, just for folks at home, the reason that the money goes in as a convertible note is so that you're not immediately, if you're the investor and you put $1 million into a company and you get a third of the equity and there's nothing in there but an idea, if the founders then turn around and liquidate, they get 2/3 of the $1 million that you've put in. So you put the money in as a convertible note before you wait and see if there's something that's going to happen in there, and then you convert when you're confident that they're not just trying to squeeze you for some portion of your money. The safes that I have seen, the idea was that we're so early on, it's so hard to fix a value here. What we're going to do is we're going to put the money in. When the next round occurs, when it's easier to fix a value, we're going to then renegotiate. We're not renegotiate. We're going to know what your shareholding is, and so you might be getting a discount. You don't necessarily get a discount. You might get some interest. Might get something else, and that's kind of how it works. When it's progressed a little bit more, and you get some more formal VC or just a bigger round, then that's when we're going to fix it. When you do these investments as the angel, how do you like to structure, and what are you looking for?
So I am I'm an LP in Y Combinator, so I get a tiny fractional percentage of every of most companies or every company that goes through, plus some of their like later stage deals where now YC is leading these Series Bs, Series Cs through their continuity fund. But I also really like to double down on founders and I would say sectors that I know well. And so historically that's been real estate tech companies, It's increasingly becoming kind of people operations and HR tech and recruiting tech. And then there's always some like just kind of like big wild swing bets that I'll do where it's like I don't know if you can build a supersonic jet, but let's spend 50 grand and find out.
Cold fusion.
Yeah, exactly. So pets.com 2.0. So I think in almost every case I am never negotiating
You're not negotiating really the terms, right?
Yeah, they're pretty much set by the founders, and I think there is a rush to get into these hot deals, and I think historically, depending on who you ask, there are these very hot deals where it's like you're just like fighting and throwing elbows, like trying to get into the deals. It's very hard to say, if the cap, which is basically like the kind of the implied valuation without actually like structuring it as an equity deal, but if the cap on a 2-week-old company is an $18 million cap, and that company is raising $2 million, the implied valuation, it's not an actual valuation, but the implied valuation is that like all of this money will basically convert at a $20 million valuation into the next round. And so, 18 cap is not crazy, right? I mean, there's plenty of extremely credible, second and third time founders now that are raising on these. There's, it's like there's a joke, like if you're any employee at any level who's ever worked at Stripe, and you go out and start a company, like you will find hundreds of investors who want to invest at a 15 or an 18 cap into your company. And a lot of times, I think to your point, like I think very rarely I'm investing pre-idea. Like I like to see, some confidence in a direction, but I think in many cases I've invested, very much pre-revenue, and on paper, and now a couple times through actual, liquidity events that has worked out. It's also not worked out. And so, I don't have, I think, these conversations and these podcasts are often about like strategy. I think the strategy for me is trying to find like, who's a founder who I know will just fucking kick ass. Like in many cases, the companies end up pivoting a little bit. Like it's very hard and very rare that I think, I've certainly seen it, but I think it's very rare that you have a founder or a set of founders where they are, a month or two into their idea, and that company or that idea looks the same at year 3 that it did on, week 3. And so you're always learning, you're always adapting. And actually, if it is the same, it's almost, in some cases, it can be concerning, because it's like, wait, you went out, spoke to hundreds of customers, talked to all of these VCs, hired experts from the industry, and you just nailed the idea like perfectly the first time, And so there's certainly a strategy in doing that, which is kind of like, I think you have to be careful in the other direction about not asking everybody in the world, what they want, because everybody's going to want different things. And so it's really hard to build a company going around and saying, hey, how can we help you? But there has to be a thesis there. But I think largely it's, there's always this idea of, do you invest in the industry? Do you invest? Is it about getting timing right? Is it about getting the total addressable market right? And I think certainly, for me, it's some crossover of, is this kind of the right time for this? What does the TAM look like? To probably to a lesser extent, but much more so like who are the founders? Are they awesome? Like, do they have the grit and intelligence and wherewithal to just like brute force this thing to success? Because I think we've all seen so many great ideas fail. Like, ideas are shit. Like, I think for the right companies, if you're going after cold fusion, or if you're going after building a new supersonic jet, you should have like a pretty clear idea of
you need an aerospace engineer.
Right. Yeah. We hope. We hope it's not, a
Trevor
couple
Milton.
of philosophy kids from Stanford or something, but you never know.
I've been joking about setting up a cold fusion company that's pre-technology, and so you can invest while we just kind of figure out, we know that nobody's ever figured it out before, but with enough money, I'm prepared to like, I'll stand at the front like Trevor Milton, and I'll roll that truck down the hill.
This is a $400 million SPAC right here. I mean, this is these are the days to be chasing that. And then you put that pre-technology idea, quote unquote, on the blockchain. Throw Bitcoin in there or something, and you've
rub
got
some
a
cannabis oil on it.
Right, exactly. Yeah. That's all worked out super well.
So when you're now an experienced founder, startup kind of manager, operator, the current thing that you're doing, you're using the strategies a little bit like consult to build some software. So you're kind of like getting paid to figure out what these guys are going to need, and then you're going to standardize that, formalize that into some form of software that will eventually become the product. Is that the strategy that you're pursuing there?
Yeah, I think this is the current company. Lasky is it's certainly a different strategy from anything that we've done before. And to be honest, I think it's a less aggressive but a really fun strategy, which is something that I'm certainly excited about. It's like I get to work with some of my best friends, and we get to like very much pick and choose our customers. It's all funded by us. We haven't raised any outside capital, and so this is like there's zero pressure. I don't have to write investor updates. We're not out there pitching. It's simply a mix of I think a few ideas that we've always wanted to build, of taking consulting and taking agency work and really truly seeing how far we can actually automate that and productize it. And so there's a few different ways there, but I think we're really starting and focusing with helping companies get their sales and marketing in order, because a lot of times I think it's a hybrid. It's like in some cases companies have no idea what they're doing, and so we can come in and actually like write that playbook. And I really like the idea of opinionated software. So opinionated software is I don't think it's a new thing. It's been around for a while, but I think a really good example of opinionated software is like goal setting, or maybe one-on-ones with your employees, which is like there were always ways of documenting and writing notes around one-on-ones, or writing down your OKRs or your KPIs or your goals for your business. There have been a number of companies that have done extremely well saying like, don't just give people a blank canvas and like give them a place to type this shit. Like actually tell them and direct them and handhold them, occasionally with like very integrated professional services who are like in the business running coaching seminars around like how to do great one-on-ones with your team, how to hire well, how to set great OKRs. And so when you look at companies like, I think that there's great up and coming companies here like Lattice, there's super established companies like Workday, but these companies generally have a thesis. Like it's not this kind of like blank slate of like note-taking software like it looked like 10 years ago in a lot of these cases. It is like do this step, then do this, and we will kind of take care of the rest. And so starting to do that with, sales and marketing, but starting with an approach of like, I think, we've built, as a team, we've built, businesses that are profitable, and we've sold a company together, and we've worked at a huge company. And I think we know a lot about sales and marketing, but we're also trying to learn. And so part of the consulting aspect is that, currently we're a month in, we have 8 clients that are like, usually early to mid stage, with an enterprise thrown in there as well. And we see all of these different ways that companies are doing things around their go-to-market strategy and around sales strategy. We also work with a lot of, external sales coaches and consultants and stuff. So a lot of this is just like, it's pure like intelligence gathering, it's information gathering. It's trying to figure out like what's working at what stage. And then through that on the back end, it's very easy to say, if I've done this thing manually, it's not a month, it's probably not 6 months, it might be a year or many years. We have a really good sense of what a, sales expert or sales consultant or sales coach or, somebody who's doing this like back office automation actually does when they go into the company. And, through software, I think that there's a lot of ways to actually like make that process more objective, standardize it, and also just bring the cost down. Like at the end of the day, we're sending cold emails here, folks. Like this isn't the end of the world. You shouldn't be spending $100,000 a month on your like cold email strategy. And yet, tons and tons of mid-market companies are doing that. And so there's a lot of things that we're excited about. And then I think, in the future, transferring that and copy and pasting and templatizing that into other things is something that we're super excited about, doing that for research and marketing and some other areas in the business.
So you use the consulting to go in and just look at how lots of different folks are doing it, and you can, because you've had some experience doing it and you know what the current state of the art is in the market, what other people are doing. You can say, have you considered this, with the objective of eventually building this software that it kind of prompts you through the process. It's not just record a note. It's like, this is best in class, or this is what you should be doing at this stage. Do this. record that, and then you can have some sort of back end that collects all of the data and statistics in it and gives you some sort of report out of that.
Yep, exactly right. Yeah, and I think the VCs don't like this idea, which is totally fine with me. It's a business where like we're a month in, we have a small team, we are profitable today. Like this is like an agency business that becomes a software business. And I think if you look at from a like, does this ever become a big business? The answer is like, I don't know. I think I would be bullshitting you and everybody. It's if I was like, yeah, this is like our very clear path to like $1 billion. I think, this idea of like taking a breath and just like not coming in like, hard-headed and saying like, this is the way that you should do everything. We're 3 weeks old and we like know our shit. Like, I think that there's mutual learning on both sides. And I think one thing that inspires me is when I look at companies like, I mentioned Workday, I think, Shopify is another classic example. Like the team at Shopify, lest we forget, I think spent 3 years with a single customer, which was basically like themselves trying to sell snowboards online before they were like ever thought like, hey man, like maybe we should go repeat this process and like see if we can make this into a platform. 3 years is a long time. And so, doing that, I think we're super comfortable just doing like the agency and consulting piece for a while. I don't know if it's 3 years. I don't know if it's 6 months. You look at Workday, like at the time that Workday went public, I don't remember exactly, but I think, close to half of their total revenue at the point of their, filing their S1 came from professional services. And so Workday was a company with, extremely legit founders who came from PeopleSoft, like they knew software, they knew what it took. But I think that the differentiated approach is that in our case, there's a million things to help you with sales. There's a million, ebooks that you can go buy on sales. There's a million coaches and consultants that you can bring in. How all of this shit actually fits together. And in a lot of cases, you have the software, but you don't even have time to use it because you're like an early stage company and it's crazy. And so if we can come in and say, like, what are your goals? Your goals are to, sell an extra $200,000 a month of software by X date. Like, let's back that up and actually talk about like how you could do that in a more kind of sustainable, automated way. And so just doing that with companies is really, on the financial side and the HR side is really how Workday got their start. And I think that there's certainly a path there for sales and for marketing and for engineering, which is just, everybody's so focused on like getting the product out. And I think in a lot of cases that's premature. Like you want a product so that you can go raise capital. And then all the time you're like, well, shit, is this the right product to go build? And so I've always been a fan, like, we certainly don't want to be in the business of selling our time forever. But it's a great way to make, to kind of build the business and self-fund the business and then see, I think we're open. It's like in a year, we could say, holy shit, we have a thing here that like will become $1 billion company and we need capital to go like double down on it and scale it. Or I think in a year we could go, we're running a $2 million a year revenue business with decent profit margins and we can hire whoever we want. And like, that's a good life. And so, I think we're kind of keeping options open.
I love the idea of the pivot. It's sort of it's not. I'm not in the startup VC San Francisco world, so it might be like me describing Goodnight Moon to you. But I'm going to give you my impression of what happens. This is just me listening to other podcasts and kind of trying to figure it out. But I've listened to this one where the value hacking period is like you're going through and you're trying to work out how are we actually going to make money or what is the problem that we're actually going to solve. And I think I find it's kind of like the most hilarious example of it is, a successful example of it is Stuart Butterfield with Slack, where they're basically trying to build a game,
right? And
they built this tool for sort of coordinating all of their other, their sales engineers, the software engineers, and that tool that they're building for the game eventually becomes the product of the company, somewhat in the same way that Shopify did it. And they contacted Mark Andreessen and they said, guess what, the game's dead, but we've got this tool. And Andreessen, I think there's a pretty famous email or something where Andreessen's just like, oh, well, what are you going to do? Like that's the way this business goes, right? So,
yep.
What's your view on the value hacking and the pivot? I'd be terrified if a business that I was invested in just changed course all of a sudden, like midstream, from a game to a tool like that.
Right. Yeah. I mean, the answer is that everybody, I think on Twitter and on podcasts, and maybe this makes me, a bad guest because it's like everybody has their thing and they're really trying to sell you on it. So, you end up with these people who are extremely intelligent, like I said, on both sides, where you have, DHH, who's building Bootstrap software, and I think their company that now includes like, hey, the premium email tool and stuff. They're doing like $30 million a year with a relatively small team. And so, he does really well by going around the world and saying like, you're an idiot if you raise VC. Like I make $30 million a year. And I drive awesome cars and I hire all like great people and we like work 30 hours a week. And it's like this very amazing lifestyle. And it's like, that's awesome, dude. Like not many people can get there. And then there's other people where it's like this is super simple. Like all you have to do is like just pick an idea and like stick to it, and like that's how you build billion-dollar companies. It's like cool. There's a couple of those built every year too. And so like for everybody else in the middle, I think that like the actual truths. I think Slack is a great example. Twitter was created out of this like basically like ideation lab, and it kind of started like I think they were doing like a podcast app or something, and then they put this out there and it became wildly successful. There's no one path. I think is the answer. Palantir, another extreme example, spent their first 6 years working with one customer. So very contrary to the advice of like go out and just like watch that line grow and see how fast you can get customers. They spent 6 years embedded with a single customer before they went out and they tried to get their second customer.
CIA or something like that?
CIA. Yeah.
It wasn't really.
Yeah, but I mean that like. How do you, I mean, this is what I don't remember exactly, but like, how do you look at a business that is doing like pure software consulting for the CIA over 6 years and go, shit, right, this is a great venture backable business.
Yeah.
Like, I mean, there's
customer concentration makes me a little nervous.
Right, exactly. So I think, to your question, the answer, I mean, I think really is as an investor, the scary thing in VC is, you don't know. And I think a lot of it is luck. Like I think every narrative that I've personally experienced around VC, is there's some, violation to that narrative, like somewhere in my own portfolio. And I look at, that's a relatively small number of companies. That's, as an LP, there's probably exposure to hundreds and hundreds of companies, but as a, direct investor, I've put money into, somewhere in the range of like 30 to 40 individual companies. And you look at like being a solo founder is like a terrible idea. Like you should never invest in solo founders. All right. Like one of my top companies is run by a solo founder. Like you should go out and do a lot of customer development first. All right. Like one company was created, literally overnight and became a huge success and, had a big exit last year. It's like, you just, it's hard to ever know. And so that's why, and I think so much of this business too, I think like anything in investment is relationship based. And so I always view it as, play long-term games with long-term people. And so if I invest in somebody who I really like, and I think that they're super sharp, like, of those 30 or 40 companies, I've only been serious about investing for, 3 or 4 years into VC backed companies, but 3 or 5 of those companies have already sold, and I have already failed rather, and probably another 3 or 5 have sold. And I treat all of those founders the same, and I think that they treat me the same. Like the companies that failed, the founders go off and they get jobs, and then they work in those jobs for 3 years, and I think that they improve and they meet people and they get ideas, and then they go off and do it the second or third time, like maybe something works there. And I think your example too with Slack is like, this is why I think classically ideas can be overrated. They're certainly not all overrated. Like there are definitely good ideas and bad, but a lot of times something sounds like a good idea and you go and try it and there's nothing there. And so going back to like the grit and the ability for a founder to go like, what is the last drop of juice we can squeeze out of this lemon before we give up, I think is like it's a very obvious quality to look for in founders, but I think like that's why it's important. There's a ton of other people who would have been like, well, shit, my game sucks. Nobody wants it. Like time to move on and go get a job at, Microsoft or something. And there's nothing wrong with that. But I think if you find the right founders who can like just, are great, like are highly efficient at using that last bit of capital in ways that, you can kind of throw that Hail Mary. There's tons of stories and tons of cases where that's, turned out to be a great thing.
There was this idea in San Francisco when I was there, and I think it's the entrepreneur. It's like someone who's it's like, what's a entrepreneur, and how do you distinguish the real thing from these guys?
Well, I think I don't know. I think everybody's definition is a little bit different. I think there's two ways that I've heard and that I've probably used entrepreneur. There's like the derogatory version, which I think is, there's this idea of a sitcom startup. And a sitcom startup is like, if you're watching, like pick any wildly popular show. If you're watching Seinfeld or you're watching Friends or you're watching Cheers or something, there's always the one character who's like always working on a business. And the business, like in the sitcom, it always seems plausible. And then you like actually think about it and you're like, shit, that is a terrible idea. Like this is, like building, like Ross at Friends is like off building like a bakery for dogs or something. And you're like, haha, that's funny. Then you're like, wait, if he actually did that, that would probably be a disaster. And so there's people that like build those, which is kind of like they just want to build something. And so they take like the idea sucks and their execution sucks or whatever. And I think in a lot of cases, the derogatory nature of that is like, you're just going through the steps. Like you're raising capital to say that you've raised capital. There's no momentum there with that capital. There's no ROI. There's no chance of $1 in, $2 out with this business. And often I think the ways that like entrepreneurs in the derogatory sense get caught up in the game is around hiring. Like hiring is a fucking mess for so many companies, because once you have capital, it's very easy to feel like you need to go use that capital on like something. And I think that there is this danger, which is like, for better or for worse, for popular companies, 10 years ago, like raising $1 million seed was like a huge milestone. I think when I raised for my last company in 2015, great companies were raising like 2 to 3 million. Now we're seeing a lot of companies raise $3 to $5 million out of the gate, literally as like a month old, 2 months old. Like they may have an idea, they may already have an amazing founding team. But if you are a month in and I plus other people give you $5 million, there is a massive danger in sprinting in the wrong direction really fucking fast with that money. And so that is what, that's something to avoid. And I think if you have a great founder and you have a great market and there's a great addressable, opportunity there, then like throwing $5 million, if they flail a little bit and hit the wrong direction, there's capital to go, readjust into the right direction. Entrepreneurs, it's like, you are going and you're just raising money because your friends raised money. And for whatever reason, you're just kind of going through the motions. And so you end up hiring people, and hiring people is fun because a lot of times it's like one of these bullshit vanity metric milestones. Like, oh, how many people work for you? Oh, like we had 5 last month and we've grown really fast. And now we have 10. It's like, oh my God, you must be
100% month on month.
Quibi had 400 people. I guess they're doing super well. So this means nothing. And, there's extremely successful, right? Craigslist, I love, because Craigslist did over $1 billion. I think it was about $1.05 billion last year in 2018. I think they have a team of about 35 people. And those companies do exist. I mean, Plenty of Fish, like the dating company, was kind of on a similar trajectory. They had like 4 employees and were doing like over $100 million in revenue. So like none of these things match up. So that's like the derogatory sense. I think the more interesting outlook for entrepreneurs is actually the concept of like, I've worked at now 2 pretty sizable companies, and there's tons of people within those companies who are extremely intelligent, extremely driven, have never started a company, but really want to start a company. And I actually view that as like massive untapped potential, like from a business standpoint, from a media standpoint, from a content standpoint. Like these are the people who, you are very interested in, 15 years ago, you were subscribing to like Inc. magazine and Entrepreneur magazine and all this shit. You may have been working at a big company or working at a startup. That was me. Like when I joined my first startup as an employee, I was just like, give me all the information about like how to be a founder. And I think, there's a number of companies that have gone after these like entrepreneurs in a very like in a very kind of ambitious, non-derogatory, sense of the word. And there's huge value to be, I think still extracted in helping people go from like, I'm a successful engineer, successful salesperson, successful product manager, at, big company, small company, doesn't matter. How do I go from like seeing what I do in this machine to like going off and creating my own machine? And that's why I think like Twitter is hugely valuable. There's like incredible people on YouTube now that are just like, this is the like show your work, that I think this is why it's so valuable on Twitter, at least for like with founders and kind of like tech Twitter, which is like, if you show your work, it's like, I get this like snapshot or this movie that probably it's a lot of like revisionist history. It's a lot of bullshit, but I somewhat see the ups and downs of like all these different founders on Twitter talking about like, a bad investor experience, or talking about how they had to bootstrap their business for the first 2 years because they couldn't raise capital, talking about how they got their first 10 customers. And I think that that's one of the reasons that I, try to do this. It's like I think very few people fall into this like, myth of like Mark Zuckerberg and Facebook, which is like entrepreneurs are all like 18 and 19 and they get a great idea and they just execute for years. It's like it so rarely happens. It's pointless. And so creating content, creating resources for like people who want to be entrepreneurs who are not, I think is an awesome thing.
So last question, how do you distinguish between the folks who make that successful leap from employee gifted in some specific vertical to being the person who's running the whole show? How is it possible to know, or is it just sort of you have no idea beforehand until they're tested, or do you have some things that you look for in particular?
Yeah, I think I don't actually know if this is true. I think it's easy to have like a thesis here that might be very wrong. I think I think personally, I like to see that you are not good because you inherited like this amazing process. Like there's this concept in sales that's like kind of a joke, but people took it as true for a long time, which is like when you're hiring a sales rep and you have 2 candidates that are coming into the office today, back when offices were a thing, remember that? Now on Skype or on Zoom, you have 2 candidates that are coming in. And, one of these candidates, she worked at Google and she was selling YouTube ads. And she's like showing you like, look at all these amazing things that I did. Like I consistently hit my quota. I did all this shit. And then the second person, here she comes in and it's like, I sold fax machines in Baltimore for the last 10 years and I hit my quota. It's like, hire the second person. Like these products are amazing. They sell themselves. Like go find the person who like actually had an uphill battle and like has the like, grit and tenacity to like go like figure out how to sell those things in 2020. And there's like, it sounds like a joke, but I mean, there's like people out there today that are like literally selling like, vacuum cleaners and fax machines and copiers and stuff. And it's like, that doesn't always translate into a great founder. Certainly not. But I think that idea of like at any level, if they're an engineer, if they're a salesperson, if they're a product person, it's easy for anybody to look good on paper. And I think one of the things that I try to distinguish is like, has there been any bad days in that process? Like, did you actually have to like fight to get there and like figure shit out and get creative and like get like in the weeds with, your pricing and your positioning and your go to market. And I think, not everybody has that. But when I look at a lot of great founders today, whether they're, first company or second company or whatever, like worked out or it didn't work out, the ability to take that and like kind of copy and paste it into a company is amazing. I mean, there's founders like, Austin at Lambda School, and Austin was like, I think he was like in the Ukraine or something, and he was like knocking on doors as like a Mormon missionary, like, trying to convert people to the Mormon faith, and
that'll teach you sales.
Like barely spoke the language, whatever. And it's like now applying that same, like, we're just going to go out and like figure shit out and do whatever it takes to like an actual product and finding product market fit and hiring people and like convincing amazing people to join. I mean, there's so many other, entrepreneurs. So I'm not saying that that's like, that is the one and only thing. But I think a lot of times you do find that like level of hustle with people who come from like non-desirable, not great companies, and they end up being like fantastic entrepreneurs. And certainly, the other can be true, but I a lot of times I think I end up like betting on the underdog. From like you were an engineer, like the world's worst company, but like you seem uniquely gifted, and like I don't know how you ended up there, but like I think if you're running your own thing, you can make it successful.
So what you're saying is my pre-technology cold fusion startup needs the pager king of Glendale to come in as my first hire.
That's right. Yeah. Find that last person who's like at the auto body shop who's still selling spinners in 2020. And get that person, moving cold fusion immediately.
That's awesome. Chris, if folks are looking to follow along with what you're doing or get in contact with you, how do they go about doing that?
Yeah, definitely. Twitter is fun. I like Twitter. You can find me at my handles, Chris J Bakke, Bakke on Twitter. You can also email me. I'm Chris at Laskie, LASKIE.co. I love just like helping. The last thing is I love just helping founders, people who are looking to become angel investors, people who are looking to become early employees at companies, all for free. Like I think that we are very big believers in the power of karma. The story that I just told somebody like right before this over email. Is that, in my last company, we worked with a handful of founders when they were like 8 or 10 people, and we were selling a product that should have been, to everybody else, we were selling it for $2,000-$3,000 a month. And I remember giving it to Tony at a company called DoorDash for like $200 a month, right? And this is like, he's like a few months out of YC, and like that turned out super well. We took a bet on a couple of co-founders in Los Angeles, and when they were fairly early, today they have 15,000 employees. So it's like you just never know. Like I think with both of these cases, it's like we probably saw some handwriting on the walls early on. There would be these kind of successful companies, but ultimately I love getting emails and just like chatting and shooting the shit with people. It's what I spend like a lot of nights doing. And so if you ever have like a question about starting a company, investing in one, or growing sales, just feel free to shoot me a note or follow me on Twitter.
That's fantastic. I'll put all of that in the show notes. Chris Bakke, Laskie, thank you very much.
Cool. Thanks so much.